G'day, Murray.
Woods, how you doing?
Good. It's been a really busy week, hasn't it? Actually, it's been a busy month. It's been utter mayhem. We went, well, by the time this goes out to the insider crowd, the long-awaited Fat Tail Capital solution is now live. Would have been live on this, but we're recording this Thursday morning. So it's going to be a busy day today, and it goes live tomorrow. So we'll touch on that later because well, I say you and Greg have whistled down 233 recommendations that are live across all of our services.
Yeah.
17 elite, best of the best crop that would be good to invest in right now. So I'm going to ask you a few questions about that a little later. But first of all, you're in different surroundings right now. You're in Hawk's Nest, aren't you?
Yeah. I'm up in Hawk's Nest at a beautiful little place on the water. It's a really nice part of the world. We've got ocean beaches. We've got the bay. It's everyone's out the front just fishing, and it's a different pace of life. As soon as I got here, it just absolutely slowed down. It's a beautiful spot.
I'd imagine it allows you to think a bit clearer as well.
Absolutely. I mean, yeah, it's just awesome. We went out. I had my first ocean dive into the ocean the other day. I haven't, been in the ocean for a while, living in Melbourne. So yeah, that moment of diving in the ocean is just, that's when you feel alive. And I'll be out there in about an hour when we finish up on this. So it's just awesome.
Yeah, great. So I thought it'd be good to get you on because not only have we what I just said about the Fat Tail Capital solution, but your update covered quite a few things this week in Pivot Trader. So I thought we could start with the state of the market and just get your take on things there initially. Now, you covered a couple of things. First of all, that the US dollars started to rally. Do you want to give us the backdrop of what you're seeing and what's going on? Because it kind of leads to everything else, doesn't it?
Yeah, well, look, we're in this moment where inflation all of a sudden has taken off. Pretty sharply, where no one can deny that it's going way above what anyone was expecting. We've got the Feds started taper. They said, okay, we're going to spend 6 months lowering our purchases. But we had the FOMC minutes actually came out last night, and there were little hints in there that they are a little bit worried about stagflation, that inflation's running away from them. They think the risk is to the upside in inflation and the risk is to the downside in growth. So there's a potential that they could actually come out and quicken the pace of taper so that they've got the option to raise rates if they need to. So you're at the point where, CPI inflation above 6% on the headline number. When look at anyone's projections from a year ago, not one person thought they'd be like that. And everyone says transitory.
I was going to say, what was it meant to be fleeting?
It's meant to be fleeting, but there's a lot of theories out there about what's really going on. I mean, the Fed's been absolutely pumping the markets post-COVID. So if you look at the Fed's share of these bonds post-COVID, and you look at it over a 20-year period, you see that after that crash in 2020, they really opened the spigots because they thought the whole economy was crashing. So I have a feeling what they've done is really they've opened the spigots a bit too hard. Yep. And also they've repaired people's balance sheets with this printed money, but they haven't created the supply that would have been created had those people been working normally and everything been functioning normally. So you've got a situation where the supply really isn't there. They've created this money, which is creating demand, and we're coming out of COVID, so demand's really spiking, and nothing is really set up and ready to cope with it. So the supply chains all over the place are creaking to a bit of a halt. And what I've read from a Bridgewater Associate article, which I thought was really interesting, was that everyone's talking about it as being supply crunch, but that's, it's just because of COVID and it's just going to be fleeting. But they're saying, no, this is a demand shock, that actually demand is flying and supply is back at levels where it was pre-COVID, but it's not coping with the immense spike in demand as a result of the Fed's actions. So we're looking at a point of they need to start pulling away the punch bowl, and they know it. And I think the next bit of news we're going to see is whether they end up quickening the pace of taper, and that will show you that the Fed is starting to get concerned and will need to raise rates. And the market is reacting, and all of the yield curve in the US, I mean, it's jumping higher across the whole yield curve. So it's from the short end all the way to the long end. But you've got the short end spiking higher So it's all going up. The long bonds are selling off, yields rising, but the overall yield curve is flattening, which is almost like a recession hint. But those big moves that we're seeing, that's having an effect. Real rates are going up. That's hit gold just recently.
I was going to ask you about that because I know you put on some gold trades, but I know that you're still pretty confident in those trades. And it looked like gold was, flying, taking off these last few weeks, but they suffered a pretty big setback this week, right? Well, the gold price did. And that's partly what's going on.
Exactly. So those short end of the yield curve is flying, and in that case, you've got the US dollar now absolutely flying. Now everyone knows when the US dollar is going up, that often puts pressure on commodities and on gold prices
because they're priced in US dollars, right?
They're priced in US dollars, exactly. But so you've got no one was really positioned for inflation to take off in the way it has. So what we're seeing happening in the markets now is that realization and waking up that, hey, it's not just transitory, it's not going back to normal. The Fed is getting worried. How high will rates need to go to chase down inflation? Will it kneecap growth? Because there's so much debt in the system. If they're forced to chase inflation, raising rates, look at our housing market where people are locking in, rates below 2%. They only need to go up to 3% for their mortgage payments to go up by 50%. So, you've got lots of debt in the system. A small rise in rates can have a big effect now because rates are so low. If rates were 5%, they'd need to go to 10% to double. Now, they just need to go to 4% to double.
Yeah.
So the whole system is very different now.
So how high do you think, if they did come into a situation where they were going to have to go, it's going to force them to raise, how high are you thinking? And
well, it's almost like this is a new experiment, isn't it? That they've pushed rates so low, and remember they've kept it so low since the crash in 08, 09, and then really this crash in 2020 wasn't expected, so they thought they were normalizing things. Then we had this crash and they've absolutely turned the spigots on, probably at the worst moment, after 10 years of money printing. So, this is all a bit of a wild monetary experiment, isn't it? So how long, and we know that the Fed always is happy to lower rates, but they've almost got to be dragged kicking and screaming to raise them. So will they drag their feet? If they're raising at quarter point increments, maybe inflation's, if inflation's 6% and the 10-year bond yields are yielding 1.5%, that's every year you're losing nearly 4 to 5% of your money in purchasing power every year. Yeah. So those US 10-year bond yields, they're looking to me quite dangerous. The market's saying that they think inflation will ultimately get back under control. But if you have 2 years of losing 5% of your money every year, that means after 2 years, you're down 10%. I mean, and they're the biggest markets in the world. Are you happy to invest your money and be down 10% in 2 years? I mean, maybe the investors are going to say, well, no, we're not happy about that. And then the US 10 years could absolutely sell off massively and still be in negative real rates. So that's where I'm thinking gold ultimately is still, there's no opportunity cost for holding gold. We've still got real rates very negative, like more negative than they've been since the 70s. So I think gold will ultimately turn around, but that is a factor. The US dollar rallying, real rates actually going up because these interest rates are going up. So that does have an effect on gold. So, it is something definitely to watch and be wary of. But yeah, all those positions we're in the money. So apart from one, so I'm happy to wear this volatility. I'm not running away.
Yeah. So you mentioned the 70s, so the way they dealt with that back then was that they had a Fed chairman that eventually came in when Reagan was in. And I mean, it was a brave thing to do if you look at it back. Like he raised Paul Volcker, right? He raised rates really high and kept them, knowing full well it was going to cause a massive recession, high unemployment. But that's kind of what almost saved the US dollar back then, right?
Well, exactly. I mean,
and the legacy system.
But they did drag their feet for a while, which is meant that inflation got away from them. So eventually, that was what other option did you have? They had to absolutely slam the brakes on. And really, we've had a bull market in bonds since then. So this is a whole generation we've seen since that moment of bond yields going down and down and down and down and down and down, or to the point where no one could imagine that they could ever really go up. And that's been behind the massive asset inflation that we've seen. So that's been like a whole generation of watching this happen. And, maybe we are getting to the end time of that. And it might take a few years to play out, but we are seeing the signs of the inflation that you would expect to be happening if the Fed's out there printing as much money as they are whenever there's any problem. But because you need the velocity of money to pick up, which is bank loans to start lending the money that's being printed. When that velocity of money starts to pick up, starts to go into the economy, that's when inflation really does start going.
Well, that's what Vern and I were talking about a few weeks back. We were talking about these same things. His view is that the velocity of money isn't there yet. Do you know what I mean?
Yeah, well, I've noticed, though, that the commercial banks in the US, the loans of commercial banks has actually ticked up. So in the last 6 months, we are starting to see
that money coming into the economy.
And yes, exactly. And the loans are ticking up. So the velocity of money is picking up. So, that's the one thing to really watch, because that's when inflation is going to really keep going. We're at an interesting juncture. And this is why, the big move in the US dollar we've seen just recently, the big moves in the US yield curve. And remember, all asset markets are priced off that US yield curve. That US 10-year bond yield is so important. Everything, as long as that rate stays very low, all of the other things that are at a very low rate are all in relation to that. So the corporate bonds, for example, they actually have a negative real yield. That's corporate bonds, which are the highest risk, bonds that your high yield bonds, which you usually have, like 10% yield or something. They're like yielding 4 or 5% and inflation 6%. So you're going into risky corporate debt and you're losing real yield. So this is a very unprecedented situation. So it can't stay like that for very long. Those rates will have to go up, especially if they're raising rates and people start saying the economy might slow down a bit. So that's going to be your highest risk point, is those corporates, who might get into a bit of trouble. So yeah, that's the thing to watch, is this yield curve, the relationship to corporate bonds, all of that sort of thing, to understand, this possible inflection point in the markets. And this is why it is so interesting, is because no one expected this. No one's really positioned for it. And we're seeing moves now happening where people are starting to jostle for position.
Yeah, right. Hey, Muzz, this is just a little thing. Your camera looks like it's shaking a little bit. I don't know if it's on and on anything, but don't worry, mate. It's all good. I'll just let you know now, halfway through the video. But you speak about it all stems from that, what's happening in the US, but how does it affect what's happening in Australia?
Well, we're the little baby brother, aren't we? So, wherever the US goes is where we go. The reason our rates are so low is on the back of what's happening worldwide, really. We are really a follower of the US. And if those US bonds really get smashed, our bonds are going to go up too. Our cost of funding, our banks get a lot of their funding offshore. So whether we raise rates or not, they'll be raising rates here for our mortgages. And really, that's where people get hurt in the pocket, isn't it? Is when their mortgages go up. So our RBA may not raise rates for a while, but if the international funding markets are selling off, our banks are going to have to raise rates because of the funding, where they get it from.
And that will sort of affect everything, right? Including the Aussie stock markets too.
Yeah, exactly. It's almost, I'm always looking at that S&P 500. I'm looking at the US 10 years, the US dollar. That's the very core of the whole system, is to understand that. And if you start seeing problems there, that's going to spread out very rapidly.
And that's why in your Monday videos, you always start off with what's happening in the US, don't you? So you're currently, the way you suggested a couple of ways to short bonds in this week's issue, didn't you?
Yeah. And that's probably the first time I've done that. And it's been known as the widowmaker trade, trying to short bonds, because it's been the worst possible thing you could ever do. You'd lose money on it, every day of the week. So to actually say that they might be ready to be a short is quite a big statement. But I think with inflation doing what it's doing, and those US 10 years at 1.5%, I mean, that's just unheard of. For 10 years, you're only getting a 1.5% yield. What's your risk if inflation takes off? I did a calculation. If the inflation stays around here, at the end of that 10 years, you've lost 40% of your money. So now, would I be willing to invest for 10 years and get 60% of my money back at the end of that 10 years? That's not a very good deal. So the market can't stay like that. So there's a chance that those US 10 years, if the market changes its mind and decides, wow, this is a really bad deal, these US 10-year bonds, and they've got trillions of dollars that they need to raise to do all of their infrastructure investment and that sort of thing, and you've got the Fed backing off from buying those bonds with printed money, all of a sudden, there's a lot of supply and not much demand. So all of a sudden, those US 10-year bonds could go from 1.5% to 3% or 4%. I mean, that can happen. People just think it can't happen, but it can happen. I've seen stuff like that happen before. And that's where I see the risk in the system is there, and the mispricing. So that's where it could unravel if things get a bit out of hand, is those 10 years could really sell off. And that would surprise a lot of people, and it would affect a lot of markets. Like those tech stocks would get really drilled. So all of the market darlings would come off the boil. And so, it's just something that I'm watching. And I think the downside of will bonds rally from 1.5% to 0.5%, the 10 years from here, with inflation at 6%. So as a trader, I look at that and I say that I don't think the yields are going to fall that far, but they could go up a lot. So that's not a bad trade. I'm willing to sort of take that on.
Yeah, gotcha. You talk about market darlings. That you mentioned in your update also Bitcoin. Is that why you're reluctant to step into the crypto side of things too? Because which kind of brings me to the Factel Capital solution. What one gave, and I remember asking you and Greg about it. I just wondered, just out of interest, how come crypto wasn't part of the long term as of right now? But obviously, the Factel Capital solution model portfolio is at the moment a skeleton, and from that you're going to grow it out.
Exactly.
But is that partly what's happening in the markets now? It is, like you said, it's the with the US dollar rising. Is that part of the reason why you're not stepping into that side of things now as well?
Yeah, exactly. That is a big effect. You've seen as soon as the US dollar's spiked, Bitcoin's actually come under a bit of pressure. But also just technically, my model had Bitcoin up in an area that was high risk for me, because it was retesting the old high from earlier in the year, and there was a bit of weakness. So I look at these false breaks where the market looks like it's breaking out to new highs, fails to carry on with it. All of a sudden, it turns back down. People are trapped in positions. The market can turn down quite rapidly. So for me, it was just in a spot where I can't buy it, and it was $65,000 then when we were putting the model portfolio together, and now it's 57. So that was, for me, a good decision not going there. And I've actually got now confirmed technical signals that it's bearish on my weekly charts. So I'm not touching it until I get a good buy signal, and then I'll be happy to go in.
Yeah. So how do you go about constructing the Factel Capital solution, by the way, it's for Alliance members only, and it's now launched. Well, it will be. We're recording this Thursday, but by the time this goes out, it's launched. It's going to be live. It's really exciting. How do you go about constructing something like this with all this macro stuff in the background? Because it's a long-term thing, right? You're not talking about the next 3 months. Which kind of, one question I have is like, surely then it's if you got the long view in mind, it doesn't matter, does it, with all these things? But
it does if things go pear-shaped. I think when you've been around the markets for as long as I have, I've seen large volatility. So your portfolio could be down 40% in 6 months. And I think people don't really get that, because in the news, they always give you a figure from the low, the major low in the crash or whatever. They don't really understand how easy it is for a portfolio to go sideways for 5 years. You look at the ASX, really, in '07, we're only near the highs that we reached in '07 in the ASX. So if you did the comparison from that, we've gone nowhere in 14 years. So if you bought just in '07, 14 years later, maybe you got some dividends, which puts you in front, but all up, you're not that happy, are you? So it's, you've really got to have that timing right. And I think after a massive rally we've seen with taper coming in the US, the inflation doing what it's doing, the risk that the Fed quickens up taper, and I don't think the market's positioned for all of this, and the yield curve is starting to show you that that's the case, that the risk is heightened for going all in right now. But as I've said before, if you've already got a portfolio and you've been taking profits, then you're still running it, because there's no signs yet that everything's about to tip over at all. The US stock market's still near all-time highs. But for me, if I'm asked, would you put $1 million in right now today? I'd say, well, no, I'd take it pretty easy at this juncture. Doesn't mean it's not going to keep rallying, of course. And if it does, we can keep adding to it. But we want the opportunity, as these new ideas come out from all of the different editors, all these great ideas that we get all the time, I want to be able to, look at them and add them in, rather than having a full portfolio and have to chuck something out.
Yeah. No, this is why you're the perfect guy to lead this endeavor. And it must have been a bit of a challenge, right? How do you select? Because the maximum amount of allocations is going to be roughly 30, I believe. And there's about
35,
30, 35, and there's around 17 constituents at the moment. Those are to buy now. So there's a scope now to build it out for the longer term. But, there's a lot of big winners in there. So the point that you made to Greg was that these are things to buy. You got to think of it from day one today.
Yeah, almost. Yeah, exactly. Look, there's a heap of great trades. The markets have been pretty good the last year, and our editors have picked some absolute crackers. But there's stocks that are up 200-300% or more.
Yeah.
And they've had their run. And, it's a very different case buying something at $8 than when it was initially tipped at $2. So, we've got to assess it from that point of view of, would I buy it today? And so that means I could really do a filter with my technical model, looking through all of those 250 stocks and say, how in the money are they? How overbought are they? How, would I buy them today? And a lot of them you could say, well, no, they're not giving a signal to be bought today. So I could filter out quite a few from that point of view. And then it was the grunt work of doing the fundamental analysis and looking at the companies and assessing where they're at. Are they at an inflection point? What are the catalysts that are coming up? Who are the investors in the stock? What's the management? Are they well respected? How the books looked over the last few years? What are they saying about what's coming? And just, whittling down into the ones that have that potential explosive upside.
Yeah. Question, Muzz. I don't know if we're going to get to do a recording before Christmas time. So I want to ask you this question now, and it's probably a question that I'm going to be asking every editor that I get a chance to speak to before the Christmas break and the new year. What's the sector that you are most excited about for 2022 from this point as you look now?
And that is a tough question. And really,
I know it's tough for you, especially because you are really big on risk management. So you got one of the best performing portfolios in Pivot Trader, but you don't look for gains. You look for you look for opportunities, obviously, but you look at how do you get in on asymmetric bets, and the almost like the secondary outcome is awesome gains. Yeah. But your key focus is on managing risk. So I know that's a tough question, but I love going after the ones that can have a massive upside. Yeah. I just like to get into one where I know that I can quite quickly get to a point where I create a free option. So that means with my method, I can go after the really high risk ones, but I do it in a way that's sort of methodical, so that I'm planting little seeds, low risk seeds, I call them, where I take part profit, create the free option, and then I can, whether it goes down or not, doesn't matter. I'll walk away, unscathed. I'll get out of the trade for no loss, or
will make money. And I'd rather be in that sort of position than watching the ticker every day. Oh, I'm losing money. Oh, I'm making money. Oh, I'm losing money.
So just so that people know what you mean by a free option is, say if you put $5,000 into a trade, you aim to at least take the initial stake out.
Yeah, Well, no, I'll sell a third of the position at a point, and then I'll just put the stop loss at a point where if it hits the stop loss, we walk away with that $5,000.
Gotcha.
So that you're going to walk away with the money you put into the trade. Yep. So from that point on, you don't stress, do you? Because you're like, I'm going to walk away with my $5,000 anyway, no matter what. So let's see what happens. And it's more exciting that way. It's far too stressful watching your money go up and down every day and worrying that you're going to lose the $5,000. So I'd rather put myself on the front foot. But coming back to your question of my favorite sector, I'm very interested in the biotech sector. I think Australia has an edge. We're definitely respected around the world for our research, and there's really massive gains that can be had from them. It's almost like the resource sector of striking gold, because when they have those phase 3 trials that come through, all of a sudden that stock that's worth 100 million could be worth 500 or a billion. So the upside can be huge, and the work can be so interesting what they're doing. There's a lot of stuff going on in cancer research, in of when how you're scanning for cancer to try to pick up cancer much earlier, because that's been a big problem, is being able to find cancer when it's tiny. And so there's lots of work going on in different methods to do that, and they're having success, and they're working their way through those phase 1, 2, 3 trials, and the potential upside is huge. So I find that really an interesting sort of area of the market to look into. I think Australia is very good at it, and I think the gains on offer are immense if you do it in a methodical way, because it's very high risk. Those ones, just as they can go up 10 times, they can halve overnight if it doesn't come out. So I'd like to go into those high risk moments with my free option, so that if it doesn't work out, okay, we get out, we haven't lost much money. But if it goes well, boy, you're on a big one.
But in terms of the fat-tailed capital solution model portfolio, part of the exciting aspect for me is that you're drawing from individual stocks from the different publications. But in order to have access to certain themes and sectors, you are going to be looking into quite interesting ETFs that can play these trends. Do you think biotech will be one of those potentially?
Exactly. And that's why I am sort of researching the different ETFs on offer out there. There's more products every day where we can put a bit of an emphasis in the portfolio on the sectors that we think are really running. So that is a great way of being able to create some diversification in your portfolio, but zero in on some of the best companies in the world in a certain sector, and be able to sort of ride their moves. And it would be so hard to do for a person with a limited amount of money to go out and invest in all of those different companies around the world, have the international accounts, et cetera, et cetera. Yeah. But now you can just buy an ETF on the ASX and be exposed to all those companies. So you've got the right diversification. So I think it's a great way to go, and the costs of them are so low compared to your super fund that stitches you up. So I think it is the way forward. That's why we're seeing so much growth in that area.
Cool. All right, Muzz, well, we'll leave it there to today. I know you've got a ferry to catch in about 45 minutes, so enjoy your day. Done a lot of work up till now, and it's exciting stuff for next year, I think. And for those of you watching, if you'd like to look into the Fat-Tailed Capital, it's an alliance-only service, and it's open. Well, it's open forever now, but there's a really, really awesome deal on up until the 30th of November, which is, I believe, Tuesday. So check it out. I'll provide a link. Thanks, Muzz.
All right, mate.
You have a great weekend, mate, and enjoy whatever you're going to do. I think you're going to enjoy your ocean diving.
Yeah, that's it.
Right,
See you, buddy.
Take care. Cheers.